I believe, make no mistake, that over 10 years, the gold price, the nominal gold price is going to be markedly higher than it is today. I think the fact that I'm able to buy high quality companies at fair prices in a market that I think gets inexorably better is very attractive. Because the things that are denominated in US dollars, like gold, will be soft, a panic engendered market. You'll just have to see what's cheaper. The opportunity that's most attractive to me is the gold stock market. Gold stocks are, relative to the gold price, not cheap, but they're fairly priced. And they've been fairly priced maybe 4 times in my career. The interest rate wants to go up, and the government is doing whatever they can by buying the long end of the yield curve and financing it out of the short end of the yield curve. There's a lot of people, myself included, who are willing to buy 1-year paper. Government is financing 1-year paper to buy back 10-year paper. The market might now look at the Fed and say, you don't have the ability to do what it takes. You can't raise taxes. You can't increase the deficit. If you bail out the system, you have to print. If you print, that's going to be wildly inflationary. But when people ask me what makes me the most afraid,
it's not a mystery that gold has come down from its highs. It's also not a mystery for those of us observing the space that sentiment in this mining space has come down significantly from just a few months ago, right? We talked about this a lot, but it's interesting for me to observe that even though the price point of gold was exactly the same, maybe last October or something like that, sentiment is completely different. How can sentiment be completely different at the same price point?
I think that people are emotional rather than rational creatures. Yeah. Developing a rational approach requires work. An emotional approach just requires feelings, and it's easier to feel than it is to think. But most people do what's easy. We try here to teach people how to think. What you point out is probably the greatest part of this timing. I was afraid in December and January of this year that I would assemble 68 great companies and have to say from the podium, these are 68 great companies, but none of them are cheap. The fact that the junior resource market is sold off by 40%, and the fact that the bad companies and the good companies are sold off in frankly equal measure shields me from that problem. Mm-hmm. I can say we have 68 exhibitors and there's some spectacular value on our floor. That spectacular value exists because the sentiment in the sector is bad.
Yeah. We're entering the second half of 2026. Fundamentally for an investor, not just in the metals and mining space, but just any investor, how do you expect the second half of 2026 to impact your portfolio differently than the first half?
What if today's fear in the gold and silver market is actually creating one of the biggest buying opportunities of the decade? Gold and silver have recently faced pressure from a stronger US dollar, higher bond yields, and ongoing geopolitical uncertainty. While many investors are becoming cautious, legendary investor Rick Rule believes this is exactly when patient investors should pay the closest attention. In this video, we'll break down why Rick Rule remains bullish on precious metals, why he's warning about risks in the credit market, and what his message means for every gold and silver investor.
I suspect it's going to be very soft in the second half for 2 reasons. I think there's less pressure on the U.S. Fed to lower interest rates. I think ultimately they will, but I don't think they'll have to in calendar 2026. That means relatively strong U.S. dollar. That means that things that are denominated in U.S. dollars, like gold, will be soft in terms of price. I also think, and I'm making this next part up, David, so I hope your people don't take me too seriously, but I think the recent conflict that we had in the Gulf acted like a tax. And as you know, I think all taxes are bad. What happened with high oil prices is that we took a lot of liquidity out of the economy. And I think that the economy in the second half of 2026 is going to surprise people with its weakness. What that means is that I expect, as an example, the copper quote to be flat to down. I expect what you're seeing in the oil market, because the high oil price, among other things, killed some demand. So I suspect that 2026 is not going to be kind for people who are impatient. For people who are patient, I think that you're going to have the ability to buy names that are high quality names, that you're going to have enough time to study them before you buy them, and you're going to set yourself up to make a boatload of money in the out years.
Mm-hmm. What about financial stocks? given that interest rates were rising? Do financial stocks usually perform better or worse during a rising interest rate environment, especially when the yield curve flattens out?
Rising interest rate environments traditionally are lousy for conventional financial services companies.
Okay.
I think it'll depend on where you inhabit that ecosystem. There are, and this is not in this particular instance an advertisement for Battle Bank, there are some community banks in the U.S., small banks, that know their local market well, serve their local market well, have no loan loss experience whatsoever, selling at 60% a book and earning 10 or 12% on capital after tax. That's a 15% after tax earnings yield if you buy it at 60% a book. That's a no-brainer. I mean, it's an absolute no-brainer. And those are banks that traditionally are run by bankers who serve through good interest rates and bad. Most people get bored with the concept of the property and casualty insurer or a community bank.
Mm-hmm.
But the idea that you can buy a 10 or 12% stable after-tax yield at 60% a book, pretty attractive. Those companies will do well.
There are some risks that we have to discuss. I think you've discussed the possibility that mom and pop owned high yield bond ETFs could trigger what could be a run of the bank, except without the FDIC to backstop it.
Yeah.
Yeah. Can you tell us more?
If I had to think about one thing that really scares me, that's it.
Yeah.
You see a circumstance where if the Fed doesn't intervene, the interest rate wants to go higher. I mean, it wants to go higher. And higher interest rate does a couple things. It hampers the ability of stressed creditors to pay. If they had trouble at 7, they're going to have a lot of trouble at 9. And it also constricts credit. It also devalues the long bond because that long bond can be replaced at a different interest yield. If you are already experiencing credit difficulties, higher interest rates are difficult for you. In answer to your specific question, what scares me is the high yield ETFs, the junk bond, or pardon me, the subprime credit ETFs have literally trillions of dollars of assets, and many of them are owned by people who don't understand the credit risk that they're taking. If people begin to have credit concerns and begin to sell those ETFs, the ETF structure itself is highly liquid, but the assets in the ETFs aren't liquid. The manager will have to sell assets which he or she can't sell to fund redemptions, which they must fund. That's where the run on the bank comes. There are some high-yield bonds that were sold over the counter in these ETFs that trade once every 6 weeks. If you have to push that bond into the market overnight to fund a redemption, the price that you're going to sell that bond for is going to reflect your distress, not just the market's distress. And that really scares me. Really, truly scares me.
But the trigger for that would be much higher rates, you think?
People are already concerned about private credit markets.
Yeah.
If people's concern extends from private credit to junk credit, which it might, I'm not saying it's going to happen, but when people ask me what makes me the most afraid, I'm afraid that many retail investors don't understand the risks that they're running in their high-yield bond portfolio. They don't understand the credits that they're writing. And if something happens like 2008 that causes them to be concerned,
Yeah.
if they head for the exits, there's no exit.
But this concern is specifically for high-yield bond investors. It's not a systemic risk that could propagate into other sectors.
Well, it could. If you have a circumstance where high-yield ETFs gate, where they don't fund redemption, the nervousness that creates in the broad market, and I'm not saying this is going to happen, but if it happens, you revisit 2008. You might not, at your age, have been cognizant in 2008, but we had a real test of system failure.
Mm-hmm.
And that's a character-building environment.
One could argue the entire system didn't collapse because the governments did backstop several large institutions.
That's exactly correct.
We can expect the same thing to happen again, right?
Except that in 2008, the aggregate debt of the U.S. federal government was about 40% of GDP. Now it's 120% of GDP. one wonders about the tools available. The Fed was able to say in 2008, we will do whatever it takes.
Rick Rule believes today's weakness in the precious metal sector is being driven more by emotion than by fundamentals. Although gold remains near historically strong levels, many gold and silver mining stocks have fallen sharply as investors continue to worry about higher interest rates, a stronger US dollar, and uncertainty surrounding Federal Reserve policy. But here's what most investors are missing. According to Rule, quality mining companies are being sold alongside weaker businesses, creating rare opportunities for long-term investors. Rather than chasing short-term price movements, he believes investors should focus on owning strong companies while sentiment remains negative. His biggest warning, however, isn't about gold, it's about the credit market. Rule believes many investors underestimate the risks inside high-yield bond ETFs. During a financial shock, those funds could face serious liquidity problems, forcing distressed selling and increasing pressure across the broader financial system. He also points out that government debt is far higher today than it was before the 2008 financial crisis. That means future bailouts could be much more inflationary, potentially weakening confidence in paper currencies over time. For gold and silver investors, Rick Rule's message is clear. Stay patient, ignore short-term fear, keep some liquidity available, and use periods of market pessimism to gradually accumulate high-quality gold and silver investments. He remains confident that the long-term bull market in precious metals is far from over, and believes patient investors could be rewarded over the coming years. So what's the biggest takeaway for investors? Let's wrap it up.
The market might now look at the Fed and say, you don't have the ability to do what it takes. You can't raise taxes. You can't increase the deficit. So if you bail out the system, you have to print. And if you print, that's going to be wildly inflationary, not merely inflationary. So the ability that the Fed has to intervene relative to the size of the problem is much lower now than it was in 2008. I'm not saying that they can't. And if it happens, they will. But the damage that they do to business confidence, to credit confidence, and in particular, to confidence in the sanctity of the US dollar is very, very risky.
So I guess the hard constraint here is inflation. There is nothing stopping the Fed from instituting unlimited QE like they did during COVID.
That's correct. What changes is their ability to fund it.
Right.
That's what changes. Remember that the debt to GDP, on balance sheet debt to GDP then, was 40%. On balance sheet debt to GDP is 115 or 120% before you take in the net present value of unfunded entitlement liabilities. There's much less flex in the system now.
Unless somehow they just lend to the banks without monetizing debt and the money supply doesn't really grow.
How? What's the instrument? I mean, the only instrument that works in that circumstance is something called a lie. And the market is not that naive. The market's fairly naive. But if the government says, we're going to kiss it and make it better, here's your kiss, where's the money?
So the bond market, the world's largest market after real estate, is telling us what now, Rick? If you look at the way spreads are behaving, yields are behaving, and
the interest rate wants to go up.
Yes.
And the government is doing whatever they can by buying the long end of the yield curve and financing it out of the short end of the yield curve. They're doing whatever they can to maintain their control over the yield curve. Right now, because people are concerned about the broad economy, there's a lot of people, myself included, who are willing to buy one-year paper. The government is financing one-year paper to buy back 10-year paper to lower the long bond yield. But the long bond yields are still rising. What that's telling you is that investors want a time premium and they want a risk premium.
Going back to your previous comment about the second half of the year being softer, which opportunities would that present?
That depends on the scenario that we face. I know you want a yes or no answer, but I don't have one. If we have a market, a panic-engendered market, you'll just have to see what's cheaper. When I look across the opportunities that are presented to me, the opportunity that's most attractive to me, probably because I know it very well, is the gold stock market. The gold stocks are, relative to the gold price, not cheap, but they're fairly priced, and they've been fairly priced maybe 4 times in my career. I believe, make no mistake, that over 10 years, the gold price, the nominal gold price, is going to be markedly higher than it is today. And I think the fact that I'm able to buy high-quality companies at fair prices in a market that I think gets inexorably better is very attractive. I think right now that the oil quote and the oil stocks are in free fall. And the oil market is a better market than any other natural resource stock. So if I looked at what I'm likely to allocate to the most over the next 6 months, it's likely to be the oil and gas business. I'm able to do that because I know a lot about it. I grew up in that.
Canadian oil and gas specifically?
I am more willing than most people to buy Canadian oil and gas because I understand the valuations in Canadian oil and gas. American investors need to decide how much Carney risk they're willing to take. My belief is that although Carney is frankly hostile to the oil and gas business, I think unlike your former prime minister, he can add and subtract. He understands that his domestic spending program requires revenue. And what Canada is better at than anything else is oil and gas. I think that he will have to be oil and gas friendly because I don't think there's any other way to fund his social program. And I think he understands that.
Mm-hmm. I think he has made some remarks recently that would support your point. He's trying to appease both sides, I think.
Yeah.
But at the same time,
I really pay less attention to what they say. I like that adage that you can tell when politicians are lying because their lips are moving. So I prefer to think about the fiscal and arithmetic constraints he operates on.
Yes.
More than what he has to say. I've been watching this guy for a very, very, very long time. He's a very bright guy. He's a very driven guy. Given that he got where he is, he's probably not a very honest guy. So I prefer not to listen to him, but rather watch him.
Rick Rule's message is simple. Don't let short-term fear distract you from long-term opportunity. Markets will always fluctuate, but patient investors who focus on quality assets often come out ahead. Now, we'd love to hear from you. Do you think this is a buying opportunity for gold and silver? Or are you waiting for a bigger correction? Share your thoughts in the comments below. If you enjoy this analysis, don't forget to subscribe, turn on all notifications, and give this video a thumbs up so you never miss our latest market updates. Thanks for watching, and we'll see you in the next video.